Rob's Child here. Security Analysis, Chapter 26. Nothing I say is investment advice, and I do not intend to replace the contents of this chapter, but provide a place for note-taking, provide a place for discussion. I'm hoping to eventually have some people interested in reading the book themselves, maybe listen to my video to review the information in their head, open up some ideas, get some of my ideas, maybe comment in the section below and share some of your ideas. I'd love to discuss this chapter or any of the chapters with you. All right, so this is chapter 6. This is the final chapter of the fixed value investing, like half of the book, right? This is part 3, I believe, senior securities with speculative features in this chapter. And specifically, the last one dealing with this is senior securities of questionable safety. And so this is, in my mind, better defined as more simply as high yield. So the idea being that any preferred share or bond that yields kind of like a lot, let's say while T-bonds are yielding 4%, high yield corporate bonds being over 10% probably right now, or higher than that, would be in this category, or preferred shares. And I've seen some of these myself in markets with much higher than 10%, because it's, these are the kinds of securities that are, the safety is in great question. And so that's what this chapter is all about. So he starts with, it's funny, earlier in the book we talk about, it's more about straight investment. Like, if you're buying a straight bond, you're paying $100 for a $100 bond that, has a coupon 4%, let's say. It's all about safety. You need that safety. But here, this is a category where we're finally getting closer and closer to stocks. And yes, the next chapter does directly involve stocks. So, and it just goes to show the amazing organization of this book. We go from complete safety to this point, leading into stocks with more and more speculative, more and more capital appreciation opportunity type investments or speculations. So, let's start with one quick point here. Speculators prefer stocks over high yield usually. And he says basically, throughout this chapter that can be an error. You oftentimes can get better capital appreciation from a company that has been devalued by the market. Let's say there's usually higher potential capital appreciation from the senior securities, being bonds or even the preferred shares, than there is in the recovery of the stock. And so if your intention, and it has been mine before in markets, to find stocks that are at liquidation levels, like if you're interested in doing that, there's better rewards in the bonds, basically, because if it does recover and we get back up to that intrinsic value, usually the bonds are the ones that greatly outperform the stock, and this chapter talks about the fact that it just makes sense that way, because so when a stock gets way undervalued, it's potentially worthless, and so is the bond. But upon recovery, the stock is still way more speculative than a bond just because of the structure of it, just because, if it does recover, it means that the principal of the bond has become safer, and so you get that added value on top of the speculation of the stock that eventually you might get some dividends out of it. So it all makes sense. That's one of the big points throughout this chapter. Okay, so I wrote here, high yield is a bad form, but it can be offset by a very, very low price. So, and that's what we just talked about. Okay. So then we divide speculative bonds in this chapter in two ways that they are seen. I think he means typically. So one way is, does the low price plus the high yield compensate for safety? And then number two, the second way of doing it is, does the lower risk of the speculative bond versus the stock compensate for the lower potential profit? And so, he basically concludes with this is that it's better to see, find, or use speculative bonds in the way that, you got to see if it's has a lower risk to compensate for the lower potential profit compared to the stock. That's the better way to see them, because the safety issue here, that's, if you're looking purely for safety, then the speculative bond is not it's not really for you. Essentially, this type of a transaction is more for trading. It's not for investing. This isn't when you're buying a speculative, when you're buying a cheap bond, the market is saying, okay, this company is going to go bankrupt, and you're saying, well, it's oversold. They're gonna recover, and so that's why you're buying it. And so again, like in following that logically, speculative bonds should be analyzed the same as you analyze a stock. So when you're looking at the different metrics, you're not looking to find the kind of metrics that you want to find to, for example, buy a straight bond from a corporation. This is not the way we're looking at it. We're looking at it in the same way that we would value a stock, and that's the next chapter. And so again, it's beautiful how this chapter kind of goes into the same one. So yeah, that's the main point there. In saying that you got to value them differently, you do have to recognize that they are different, that a stock is not the same as a bond. Moving on, a fantastic quote that I really like in this chapter is where he says, "Time brings unpredictable changes of business undertakings." And he does a whole thing in the appendix with Mead and Grodinsky explaining how their view of investment is that the only stocks you should be investing in are in industries that are expanding, and be highly aware of industries that are declining. Like, look for, if you see any signs, get out, get into only get into things that are expanding. Interesting idea. I mean, certainly that has been proven useful throughout history, right? We have the 90s, um, the computer bull market, that industry. If you got in that, you became pretty rich. Just in the late 80s, 90s. Um, Obviously the Industrial Revolution. You got in on Ford early, or anything that's new, a new expanding industry, something that is like people are touching on it, but it's like set to take off. And I mean, most applicable today in that area would probably be artificial intelligence. Obviously, we're just starting that area, and so they would probably suggest to only be invested in AI at this point if they were alive today. So, but the overall advice that comes from that quote I just mentioned from Graham: time brings unpredictable changes of business undertakings. It's applying not just to, it applies both to areas that can be overvalued or undervalued. So you're always going to have events and things that change the qualitative qualities of companies and industries that can greatly change the market value of them. And just time brings these unpredictable changes. And so so part of the chapter that he mentions there is how you can have companies that show declining earnings, for example, after having great earnings for 10, 20, 30 years. They've had like awesome earnings, and all of a sudden it's declining. I think one thing he was mentioning in that chapter, if I remember right, is to not be too scared off by declining earnings, especially if you can figure out, however, that the earnings can or will recover, for example. And there's examples, obviously, through the Great Depression and through lots of bear markets. Lots of companies have temporary reduced earnings, especially in bear market situations where overall economic activity is slowing down. That's not a place to get too scared off by declining earnings, because it's it's pretty inevitable and obvious that they can recover. A lot of businesses that have declining earnings. All right, next few points we already covered. He mentions again for the umpteenth time that preferred shares are bad and terrible, unless that there are certain cases. I mentioned them earlier in my videos that like he just had a suggestion that that's how it should be. It doesn't, but it typically isn't that way. But there are cases where it is that way, referring to voting power going to the preferred shareholders in the case of default, if it's defined as, for example, not paying the dividend on the preferred shares. But yeah, so there's an example here. He mentions that how they can have an advantage to the common shares under duress because of their semi-contractual claims to payments. Again, with the voting power, if you put them in charge. But I think most of the time that's not the case. Obviously, I'm not an expert at this point at the normal proceedings in default and bankruptcy. I mean, I feel like I've heard stories about companies defaulting on their bonds and then, things playing out the way the book even suggests, where you have a third party come in and figure out how to deal with it all, and voting power and all. I don't know. So is going to change. I mean, obviously, if you're not if you're not covering the bonds, especially, a bond is a bond. All right, moving on. The next section refers to. I've been trying to wrap my head around some of these concepts that I don't fully get. I get it in a way, but anyway, let's just say it. So he mentions how high working capital is better for bonds, and it's not to benefit the stock, but it does benefit the bonds. And I think it just means that the business is legit chugging along, and the payments are going to be coming in. And I mentioned he shows a great example in that area. All right, next part, I wanted to talk about how sinking funds can help intrinsic value of bonds, preferred shares as well, but not the stocks. He shows examples of this being a great investment, for example, even during the Great Depression, because of the way it was structured. People that bought these kinds of bonds when they got sold off did very well. Even, if you look at the history of the overall stock market after when the Great Depression started, they stayed down for a long time. People stayed out of stocks, but investors did well if they bought the right things, and this is what he is referring to here in this section. And then the other one, he lists a bunch of examples of how that works, along with companies that have large net current assets, making the bonds very safe, to the point where the company buys them back at a profit for they call them at a profit for the investors, on top of the payments, making the payments. But he says that he makes lots of examples of how this occurs. Having large net current assets can make bonds very safe of a company. However, he does mention it's not always a dependable metric. It's a little more complicated than that. And so buying, again, like buying these kinds of bonds under duress, he says this is what he says it's not an investment and it's not a speculation. It's in between. He calls it an investment operation. The way I define that as arbitrage. I don't know if that word existed at this time, but I see it as sort of a type of arbitrage. You see, obvious value in something that has been, sold off without good reason, and it's like, I don't know, the price of gold. And then what was it? It was in the 90s or early 2000s. It was down in the 200 range, $200. I mean, I don't know. It doesn't apply to business, but it just makes me think of, that, an investment operation, when you see something is just like laughably over sold, buy it up, gobble it up. Yeah. It's an investment operation because it's like, speculation is more on the side of like hoping things become overvalued. Investment operations being something that you get something that's clearly worth 10 times what it's being sold for now, so you can buy it at this price. You can sell it at only half of what it's really worth, and you still made out like a bandit. But anyway, he also mentions in this area that group purchase in a certain field can be safer in this category, which is so interesting because my own sort of market timing plan has been like, if we get into another really serious bear market where everything gets sold off, high yield corporate, I just from chart reading, I didn't even read this book before, but I came to the same conclusion from reading the charts, I saw if you look at what happens to high yield corporate, there's a fund HYT, and how quickly it recovers from bear market bottom compared to stocks, you clearly get a much higher capital gain a lot faster than the stocks recovering. The stocks eventually outperform and continue upward, but that's part of I do intend to buy a basket of high yield corporate if it ever gets crazily oversold again. I missed the recent October opportunity. It was October 2022. We had a pretty major bottom in high yield corporate. I asked someone I thought I respected in the investment world about that, and he suggested to not do it because of a VIX curve or something like that. I stayed out even though my better instincts told me to buy it. I could have made out like a bandit right there. But anyway, I'm ready for the next wave. If we get to that section personally, but let's move on. I want to talk about the chapter, not about me. So then we have a section on intrinsic value, logical rules between seniors like bonds and preferred shares versus the value of common shares and the maximum potential value. And it's basically some arithmetic that kind of suggests, like, the whole value of the company has, depending on how you divide up the capital structure, there's rules as to how much value it can potentially have. And it's interesting stuff. It's good to be aware of and to understand. So if you're comparing like two companies that are literally replicas of each other and they have different capital structures, you're able to kind of detect maybe even a semi-arbitrage situation between them with this. And he says the most useful way to use this information is to actually determine if preferred shares or bonds are overvalued intrinsically. So so I don't know, you can short those bonds or short those specific preferred shares maybe in that case if they are above their maximum intrinsic value. And yeah, he shows examples as well as how that can occur. How one conversation I had, one conversation point that I've brought up in the past with people is like, well, how can I beat the market? How, like, obviously there's people that do this for their living, lots of people in the financial industry that are much more intelligent and have a much deeper background in finance than I do. How can I beat that? Like, if there's an opportunity, it's already going to be taken. And, reading this book and then looking through history and just observing markets over the past 5 years at this point, something like that, 4 years, has led me to conclude that this stuff clearly still gets overvalued and undervalued. I mean, the dot-com bubble, we still have, like, obviously, like, the mob mentality investing, these meme stocks. It's obvious that things get out of control. One other point I can mention right now, sorry about going off topic from the chapter a little bit, but apparently Michael Burry was in on the GameStop squeeze. He got in and out before the squeeze happened because he also saw what the GameStop memesters saw before it got out of control. He got in and he got out with his profit. He's happy with it. Guys like this inspire me, along with Graham. Graham I don't think likes the idea of participating in some of these like meme stocks that go, absolutely parabolic, it's like, oh, I could have, if I had only held on from this point to this point, I could have made a huge profit. Like that's not proper thinking for an investor. A 25% gain in a short amount of time is huge. We can expect sort of at this point like a 9% average return just for investing in the S&P 500. So if you're beating that over the course of a year, you put in a chunk of money, you get 25% return over the course of a few months. I mean, annualized, that's a very, very, very large return. Getting too greedy is not well advised. It's not a good investment plan, because but anyway, I digress. If you can't tell, I'm excited to finally have gotten through this part of the chapter, this part of the book, because we are finally starting the part of the book that most people probably skip to, part 4. Do I regret reading part 1, 2, and 3? No. I think he builds upon prior knowledge in this book consistently, and I think reading the first 3 parts of this book will help us understand the rest of the book much deeper, much better. Again, another thing I really like about this book, he references other chapters in the future and further in the book and past in the book. He's like, we reviewed this, we already talked about this. Oh, we're going to talk about this and how this relates. Like, that's a very useful way of organizing it. So anyway, so we've made it through the bonds and preferred shares and everything, all of the most important things that can be done in that area. And now we will be progressing to part 4, theory of common stock investment, starting with the dividend factor. So hope you enjoyed this episode. Please discuss this chapter in the comments below. I will join you. I will respond to any comment made on any of these videos. I hope you enjoyed this video, and that's it. Rob's Child.